Hello and welcome to this DipIFR mock debrief for December 2025. My name is Jane Howson. I'm a chartered accountant and I've been working in exam-based training for a number of years. Today we're going to go through question number 3. Here we can see question number 3 has got 2 exhibits, a requirement, and we have a word processor and a spreadsheet. The examiner has requested that we can use the spreadsheet for numerical answers and would prefer written responses to go through the word processor. Now, what we've got down here are 2 exhibits, one on post-employment benefits, which is going to be broadly pensions, and the other one is on a sale of goods. Topic that's come up before in the exam and is slightly tricky. There's lots of work to do on this one. Now, if we have a look at the requirement, we can see that there are 25 marks, and we're going to get marks for both numbers and for words, as it says down here in the second bullet point. But we're going to get an idea of the mark allocation when we come to have a look at each exhibit. Now, what's really important is that what they want us to do is to explain and show how the transactions are accounted for and reported. Now, what does that mean? It means tell me what the rules are in relation to IFRSs, and also make sure that you put the numbers down that are going to go into the financial statements and tell us where those are going to get reported. So let's have a look, first of all, at this first requirement, which is talking about Delta. It's got 2 types of post-employment benefit plan. Now we can see that we have 14 marks down here. And as we know, the question talks about plan A and plan B and gives us numbers for both. Now we're told in plan A that the benefits of the majority of employees, the contributions paid are invested to produce an appropriate growth in the value of the plan. The ultimate level of post-employment benefits receivable depends on the level of contributions. And this is basically telling us that these contributions here, I'm just going to move this over to, if I can, just going to move this over to this side a little bit. The point about these plans are that it's up to the employee here. It depends on what the plan's done as to how much they get. Now, we know that we've got to put into words here, we've got to talk about, first of all, how they should be accounted for, describe how they're accounted for, and to show the numbers. So I think we're going to start with plan A over here. I think I'm going to put this in the word processor. I'm going to call it plan A, and we're going to explain that according to IAS 19, which is the one on employee benefits. Remember, it's not just about pensions, IAS 19, but it does cover most of this. What we're looking at here, this is a defined contribution scheme. Now, I need to explain why. This is because the risks lie with the employees as their pension depends on how much has been, what's the word, built up, or how much has been invested by the time they retire. Now, let's talk about how this is going to be included in the financial statements. There is no, spell this rightly, there is no responsibility for the employer to make up any shortfall. And so the contribution paid is the extent of their responsibility. Therefore, the statement of profit or loss will show contributions paid, or should say payable, this year, and there is no asset or liability on the statement of financial position. Now, I think I've explained the rules. What I've now got to show is what's going to go into the statement of profit or loss. So let's just close that for a moment. Let's have a look at the amounts down here. What we can see is that we have a contribution here of 45,000. The rest of the numbers are irrelevant. So the expense, and this is going to be shown, remember, under the operating category of expenditure. Is going to be, oops, I put a pound there. It's going to be $45 million. So I have explained what it is. I've explained where it's gone. And basically, we can ignore all the other figures. There we go. Now, remember when you look at the mark allocation, there are 14 marks. I have explained, first of all, what's got to happen in this, and I've also explained why, and I've explained where it's going to go, and I've given a number for this. Now, the mark allocation is only going to be about 3 or 4 marks for the description and 1 or 2 for the numbers. So out of those 14 marks there, I'm guessing about 5 or 6 are probably going to be applicable for Plan A. Now, let's have a look at Plan B. Now, Plan B is going to be a different type of pension because we're told in here that it's restricted to directors. We're told that it's the amounts that are based on the salary of the relevant employee at the date of their retirement. So basically, what the company's doing here is promising to pay the employees a certain amount. This is going to be defined as a defined benefit scheme. And I'm going to explain why. Because the company, the entity, has promised that the employees will retire on a certain sum. Now, what does this mean? What this basically means is that we need to show a lot more detail than we do for a defined contribution scheme. So therefore, the statement of financial position will show the liability for the amount that the company must contribute towards the retirement fund. Now, obviously, we need to put some numbers into this. Now, I haven't really got any numbers to hand. I've got a load down here. I can see that I've got some figures in here. So what I think I might do at this point is open up a little spreadsheet, get some numbers, and then I can start describing. Now, first thing that I need to do here, whenever I do a spreadsheet, I always extend the first column here. And I'm just going to write in that this is going to be my pension liability. And I've got lots of workings to include in here. So I'm going to have the assets and I'm going to include the liabilities. And all of these numbers are going to be in thousands of dollars. You can put them in millions if you want to, but I think it's probably easier to do these in thousands. And what we're going to do first of all is we're going to work down the numbers and we're going to try and, if I move these numbers over here, we're going to try and I'll put that a little bit smaller, move that up a little bit. Can we move that up a little bit? Maybe we can. There we go. We can move this down and then we can put some numbers in here. So let me extend that a little teeny tiny bit. So what we've got with this second scheme, we have some contributions. Make this a bit bigger. There we go. So we have, first of all, they've got the contributions, the benefits, the brought forward figures, and they've got the carried forward figures. So let's first of all put the brought forward figures in, and we can see that those are on the 1st of April, we have obligations of 190, and we've got a little bit further down, we've got plan assets of 140. We then have contributions payable into the scheme. So those are going to be an inclusion into assets, debit assets, credit the bank. We've got the benefits paid to employees. So this is going to be sums coming out of both sides. We no longer have the money in the bank, but we've also don't have the liability. We've put the opening balance in. We'll put the closing one in a bit. The other thing that we've got down here is the current service cost of 14. So I'll put that in there as well. Now, a service cost is going to be a debit to the statement of profit or loss and a credit to the pension fund. What else do I have in here? Well, I'm told that we've got some contributions are paid evenly, and I've also been told down here the relevant discount rate to apply to the calculations is 8%. Now, the problem I have here is when I'm working out the interest, what you might do with the 8% is to just take 8% of the opening balances. Strictly speaking, what we need to do is to work out the average balances on these to work out the sum. So what we need to do is look at the opening balances for both, the 190 and the 140, and I'm just going to try and make this a little bit bigger if I can. Don't seem to be getting much luck here. Keeps coming up with a little pop-up. Okay, let me just move this down a little bit and let's have a look at a working for the interest. So what I'm going to do here is I'm going to have the asset and I'm going to have the liability. And again, I'm going to do everything in thousands of dollars. And I'm going to put the brought forward figure in. So this we said before was 140 for the assets and 190 for the liabilities. What I'm then going to do is I'm going to work out the average. I'm going to work out the average amount of contribution and benefit so that I can then work out the average interest. So the contributions paid into the plan are 15,000. But if I take 15,000 and divide it by 2, because that would then show the 6-month figure, and then I'm going to take the payouts or the benefits, and that's going to be half of the 9,000 if it's going to be paid evenly. And I'm just going to copy that across there to that side. And that's then going to give me the average carrying amount of the pension. So that figure there, I'm just going to put equals sum, and I'm going to highlight these numbers here. And then I'm going to do the same thing by clicking and dragging it. Oops, no, I'm not. Let's go back. There we go. Let's see if I can then move this up slightly. I nearly got my little faint cross there. I'll just make it this, do the same thing here. It's probably easier. Add these down, and I've got 185. What I then got to do is to work out the average. So what I'm going to do is I'm going to work out 8% of those. So the interest equals 0.08 times by that. And I'm going to do equals 0.08 times by that. And that's going to give me the interest figures. I can then put those interest figures straight into my working. Now, here I've got B22, C22. If I go up here a little bit, I'm going to put the interest in. Figures in there. Now, both of those interest figures will increase the assets and they will also increase the liabilities. So then all I've got left to do, I think, is to work out a subtotal for those, find out what I think the double entry is going to be so far. So the assets will have a value of 157,440. And I've then got the liabilities with a value of 209,840. And then what I've got to do is to work out what the OCI figure is, which is my actuarial gains and losses. So I know that the liability here, I'm told the year-end balance for the liability is 220,000. And I can see over here that the balance for the assets is 165. So this figure here, which are my actuarial gains and losses, are going to come in here. So they are the difference between that minus that. So this is then going to give me a gain. And then I can see here that I've got a difference between 220 minus 209,840, which is a loss. And if I look at the net figure here, I think I've got an overall loss because it's making it bigger. And that overall loss is going to be that minus that, which is 2,600. So what I've got down here are lots of numbers that I can then include in my answer. So I'm then going to go back to the Word document, and I'm going to start explaining what these figures are. So I think the first thing to state is that the non-current liability. Now, notice down here that the question asks me for where it goes and what it is. The non-current liability at the year end is going to be the difference between the 220 million and the 165.5 million. And we can see that that is, I'm going to put that in brackets actually, we can see that that comes to the total that's going to go on to the statement of financial position. Sorry, no, it's not 165.5, it's 165. I'm making up numbers. There we go. So we then have 55 million, which will be our liability. Notice I've said where it's going and what it is. Then what I'm going to do is to show what the other numbers are. I can see that the statement of profit or loss will have an expense for employment of, and this will be the current service costs. And we know that the current service cost was going to be, I think the total there was the 14 million. I think that's right. Let me just close these down a minute. That was the 14 million back into the word processor. So we've then got an expense of 14 million. What we're also going to explain is we're going to have a finance cost of the difference between the interest received and paid. Now, we know that we calculated this before. If we go back and have a look at our spreadsheet, we can see here that the numbers that we had for that, a little bit further down, I think we had these two numbers here. If we look at the net figure, we've got a difference of that minus that. So we're going to have interest payable of 3,400. So I'm going to put that in here. Well, it's going to be 3.4 million, isn't it, when we put that in there? So we can see that in the spreadsheet. And I think, what else do we need to have on here? I think we've got the liability, we've got the interest. Oh, we want the OCI, don't we, next? The actuarial, and here we've got an overall loss and we said that that was 2.6 million from the spreadsheet, is recorded in other comprehensive income. Now notice I've explained, I've done numbers, and I've told the examiner where those numbers go. So quite a lot to do there. And I think when you're looking at the marks, I think we're looking at quite a lot of the 14 marks there are going to be for the second part of the question. There'll probably be about 5 or 6 marks for the numbers. Do what you can, just remember to explain where they go. Now, the second part of the question, and I think I can now do away with all of this. I don't think we need that anymore. So let's close that down. Is let's have a look at the sale document. So the sale document here is a sale of goods is talking about Delta, who sold and delivered 200 identical items to a customer for £5,000 each. The items cost Delta £3,000 to manufacture, and the terms of the sale, the customer has the right to return them for a full refund. And it says after the 2 months have expired, they can't return them anymore, and then we can immediately charge the revenue. We're told that Delta has entered into transactions of this type with this customer previously, can reliably estimate that 5% of the products are likely to be returned within the 2-month period. The customer returned 6 of those items. No change was necessary to the original estimate. So basically what we're saying is that 5% we think are going to be returned at some stage. They've just returned some of them now, slightly under the 5%. And what we've got to do is to try and put those in the financial statements. Now, you can use a spreadsheet to come up with the numbers here. Equally, you can use the calculator up here if you want to, if that's easier for you to work out, or you can use your own calculator if that's easy too. So what we've got to do here is to try and work out what all the numbers are to go in for the sale and return. So I'm going to put this sale and return of goods. I do need the marker to see what part of the question I'm answering. So basically what I'm going to start off by doing, as I normally do, is to explain the rules. And this is going to mean that we're going to have to include something on IFRS 15. So I think we're going to start first of all by explaining that IFRS 15 on revenue is relevant here. I'm not going to list out all of the steps, although I do find that it might be useful here just as an introduction to very briefly mention what we need to cover. There is a contract to sell and buy, so we can record revenue. There is one performance obligation, and that performance obligation is to supply the goods. The transaction price contains a variable element. And you will get something for identifying it's a variable element. Now, the variable element is the fact that there could be some returns. And the goods can be returned. What we need to do, we need to identify in here what the probability is. Here, we are told it is 5%. So we have the 5% return. So when we start thinking about how we're going to include these numbers in the statement of financial position, we're going to first of all start putting some figures in. The transaction price for the goods sold is going to be the 95% of the items. We're told that they were sold for 5,000 each, and there were 200 of them. So 95% of the 200 means that we do have a sales price of £9.50. And you can put that down on a calculator if you want to, if that's easier. And this needs to be obviously allocated to revenue when the performance obligation is met. So we will put that in when the supply is made. Now, what we then need to do, though, is to identify when the revenue is going to be recognised in full. Now, what are we told in the question? Well, we're told in the question that the sale of goods here, we've got a 2-month period. We sold these on the 1st of March. So what we're going to include here in our word processor is we want to state down here that the revenue is recognised in full when those are delivered. So 1st of March. Always try and apply if you have dates and you have figures, because what you're demonstrating is not just knowledge of a rule, but knowledge of how it's going to be applied. Now, what we're also going to show is a trade receivable. On the same date, we record a trade receivable. Now, the receivable, though, has to be for the full amount of the goods that have been delivered. And these are going to be the £5,000 times by 200 items, which is going to be 1 million. Now, we know, though, that there's a difference here that doesn't quite balance, doesn't it? So, oh, it automatically did it for me. There we go. It's 1 million. The difference, and here you can see that the difference is going to be between the 950,000 and the 1 million, which is 50,000, is going to be described as a refund liability. So what we've done here so far is we've recorded where those sums go. Make sure the examiner knows that this is a current liability. So you're explaining where it goes, because it's going to be settled very, very soon. Now, so far, we've dealt with the sale. What we now need to think about is the cost of goods. Now, as far as the cost of goods are concerned, the total cost of goods is the amount that we've taken out of inventory. So this is going to be 200 items. We were told that they had a cost of 3,000. So I think that that's going to come to $600,000. Now, what we have to do here is remove the goods from inventory, because they are no longer in our warehouse. So we can't show them as an asset on the 1st of March, 20x5, so when those are delivered, but only the amount so far, or we're going to take all of them out, I should say, but there's only some of them can go to cost of sales. And I'm going to refer to the 95% of the 200 items that were sold for or had a cost of 3,000. So that's going to come to, put that in brackets. It's not calculated that correctly for me, has it? Look at that. So that's going to be 570,000 is the amount that we are going to take out of inventory and will include in cost of sales. The difference, the 5% times by 200 items times by 3,000 is going to be shown, and this comes to 30,000, I think. This is going to be shown as a right of return asset. So what I have is a credit to inventory of 600,000, a debit to cost of sales of 570, and I'm then going to have a debit to what I'm going to call a right of return asset. And this is going to sit as a current asset in my statement of financial position. I'm saying it's almost like it's inventory. It's just not on my premises at all. So far what I've got is I've dealt with the original sale on the 1st of March. When the 6 are returned, so I'm told that in the question that we had 6 that were sent back to us. What I then need to do is to think about how this is going to be dealt with. It doesn't affect the original revenue because I only thought that 5% were going to be returned. I'm not quite into the 5% yet. I haven't hit that 5% of 200. And these are within the estimate. So I don't need to change the sales at all. Basically, though, I do need to think about what's going to happen to the trade receivables. Now, I think what I need to do here is not change the revenue, but reduce the trade receivables and the refund liability because I don't owe them that anymore. And I need to reduce both by 6 times by the sales price. So that is also going to come to 30,000. Now, if you want to, you can put a journal in, but don't assume that by writing a journal, you're going to get full marks. You won't. What it means then, the balance on receivables is now 970,000 because that's going to be the 1 million less the 30. Again, I'm demonstrating what's going to be in the accounts. And the refund liability, which I had in originally as a figure of 50,000, further up here. Where's it gone? I had my somewhere in here I had my refund liability. Here we are, refund liability of 50. That's going to go down to 20. So that's going to be the 50,000 minus the 30,000. The inventory is now going to be increased because these goods have come back. And those are going to be sitting in the books at 6 times by 3,000, the low of cost and net realizable value. Notice here that the cost is still lower than the net realizable value. And I'm going to increase the inventory. And at the same time, I'm going to reduce the right of use asset. Not right of use asset, what I'm talking about, right of return asset. So it's now come out of the right of return and it's now sitting in my inventory. Now, this means the balance on the right of return asset is now 12,000, which is the original 30 minus the 18. I think I missed a 3 off here, didn't I? There we go. So that was my right of return asset that's now being reduced. Now, it's a lot to do in here. I thought this was actually quite a lot for 11 marks. There's a lot of numbers to do, but you've actually don't start by writing out everything you know about IFRS 15. Put the relevant bits in. The relevant bits down here, keeps calculating things for me. The relevant bits down here are going to be to do with the transaction price and that it's variable. We know that it's a probability. We're fairly certain what the probability of returns are. We're going to state what that revenue is based on the date that they're sold with the probability. And we're going to record the trade receivable and put the difference in as a refund liability. We've also got to deal with the cost of sales on the 1st of March when we make those sales. So we're going to put in 600,000, 570 comes from inventory, 30,000 is going to be recorded as a right of return asset. When the 6 come back, we don't need to change revenue because it's already been dealt with. What we do need to do is to remove the receivables if we can. So we've then got to change the receivables because we no longer own it and reduce the refund liability. And at the same time, put those goods into inventory and take them out of the right of return asset. Notice how where we can, we state what are current and long-term assets and liabilities are. Well, I hope you found that useful and I look forward to seeing you for the next debrief.